Okay, so in the last part of the chapter, we were introduced to that adjustment process that has to go through before we actually close our accounting records for a period of time, whether it's 1 month or no more than a year. And those are called adjusting entries. And so we're going to be learning about in Objective 2, we're going to learn about those adjusting entries that are considered deferrals. So to defer, again, means to delay or postpone. So when we talk about deferrals, we're basically talking about um, assets that we buy, but we're going to use quickly, so they will be expensed after they're used. Those are also called prepaid expenses. Um, and then we have one liability account, unearned revenue, that after we wait, right, that's the deferral piece, we probably earn some of that money. And so this should be in our revenue account. So in other words, prepaid expenses or deferred assets, they start as assets, they end up as expenses, right? Unearned revenue starts as a liability account, but after we earn it, it ends up as revenue. Okay, so notice that these are currently on the balance sheet, but they need to be on the income statement. And that's why we go through the adjustment process. Okay. And so basically speaking, this is the first part. There are 3 prepaid expenses that you're going to learn about in this part of the chapter, and one instance of an unearned revenue that you're going to learn about. You only have to know these deferrals for this chapter. Okay. So again, a prepaid expense basically starts as an asset, and then after we use it, it turns into expense. Now, there's some assets that you are familiar with. You understand, you've already been introduced to prepaid insurance, and you've already been introduced to supplies. You've been introduced to buildings and equipment that are subject to depreciation. What you haven't been introduced to yet is something called prepaid advertising and prepaid rent, very much like prepaid insurance, right? So these are all what we consider prepaid accounts. That's actually the name of the account would be prepaid insurance, prepaid advertising, or prepaid rent. But all of that it starts as a current asset, okay? Insurance, supplies, prepaid advertising, and rent are all current assets. Current assets are either going to be turned into cash within the period or used within the period. And so in this case, these particular current assets are going to be used or consumed. Once these assets are consumed, it becomes an expense. So insurance is prepaid insurance is an asset. It'll eventually be insurance expense. Supplies is an asset. It'll eventually be supplies expense. Prepaid advertising is an asset. It'll eventually be advertising expense. Prepaid rent is an asset, but it'll soon be rent expense. How soon? Whenever we use it. Okay. Buildings and equipment are subject to something called depreciation. And depreciation is simply a way of allocating part of the cost of this to something called depreciation expense. The interesting thing about the buildings and equipment is that happens over many years. So depreciation expense is a very slow process that happens over many, many years. Whereas these other accounts are current assets, we're gonna have a supplies expense and an insurance expense and a rent expense every month for sure. Okay, but that's going to be a little bit different. We're going to use these up very quickly. Equipment and buildings are going to depreciate very, very slowly for many, many, many years. Okay. So again, we need to adjust this because again, these are assets that need to be expensed. So we need to debit the expense account for whatever we've used, and we will credit the asset account to show we've used it. Okay. And so basically speaking, how an adjusting entry works for all of these prepaid expenses, which are, again, assets that eventually turn into expenses, is we will debit their expense account, whether it's supplies expense or insurance expense or depreciation expense, and credit the asset account that's affected. So this is going to be the adjusting entry at the end of the period for all of these. So let's look at each one. First is supplies. So again, supplies are purchased usually in bulk, but they're used up quite quickly. Sierra Corporation bought $2,500 of supplies, okay, at the beginning of October, which is great. At the end of October, so the period is a month here, at the end of October, they look and they only have $1,000 of supplies left. On hand means left over, what they still have. So if you started with $2,500 of supplies at the beginning of October, and you ended October with only $1,000 of supplies, you've used $1,500 of supplies. So if you've used that, you need to expense it at the end of that period. So at the end of October, you would have this adjusting entry. Supplies expense would get the debit, showing that we've used up those supplies. Supplies would get the credit, showing we used up those supplies. Right? So basically speaking, this is what the journal entry would be, and this is what it would look like when it's posted in their accounts in the ledger. The supplies account, remember, supplies is an asset. We've used it, which is why we've credited it, because we're decreasing the asset. We have 1,000 of supplies left at the end of the month, which is what this is also telling us. So that information matches. Because we've used all that, we can expense what we've used, which is what the supplies expense is. Okay. So again, the posting sort of happens. This is why I told you you can't forget anything you did in chapter 3, because look what we just went over. This is the first thing here is a journal entry, right? This is a journal entry. The second thing here that you see is posting into the ledger. And you know what's coming after all these. In a learning objective 4, there's another trial balance coming. So you can't forget anything that we just did in chapter 3. Okay. So that's this is what you have for supplies. This is how supplies work all the time. Okay. You're going to debit supplies expense and credit supplies when you make an adjusting entry to supplies at the end of the period, whether the end of a month or the end of a year. It's the same entry. This is the same journal entry all the time. Insurance, again, prepaid insurance starts out as an asset. It's a current asset. Remember, Sierra Corporation bought a 1-year policy for $600, right? That's 1 full year, which is 12 full months, right? They started in October. We are at the end of October. So we have used 1 month of the 12-month insurance policy, okay? And so we can expense that $50, which is what 1 month is of 600. 600 for the year divided by 12, $50 a month. So we've used up $50 of that insurance policy at the end of October. So now we need an adjusting entry to show that. Look at the entry, quite simple. A debit to insurance expense, a credit to prepaid insurance, right? Insurance expense shows the expenses are increasing. At the same time, we have used the prepaid insurance, and so that is decreased. And so what we have here is the journal entry, and then you see it posted in the ledger. Notice what happens. At the end of October, the balance in prepaid insurance is now $550. It's no longer $600 because we adjusted it. This credit adjusted it, showing that we had an expense. We've used up a portion of it. So this is how insurance is expensed every month. Okay. And again, this entry is the same for insurance every single period. As I was mentioning earlier, depreciation happens for what we call property, plant, and equipment accounts other than land. Because when we buy equipment, we know it's only going to be useful for the business for a period of time. We call that period of time its useful life. So if I had a pizza restaurant and I bought ovens for that pizza restaurant, I know I'm only going to be, those ovens are going to be on all the time. You know, they're going to be on 7 days a week. I'm going to use those ovens a lot. It's a piece of equipment. It's not going to last forever. And so it's going to have a useful life to my business before I have to replace it with another pizza oven. Right? And so that happens over many years. Depreciation allows us to allocate the cost of the asset. So I can allocate a portion of the cost of my pizza oven as an expense slowly over many, many years. Okay. And that basically is what we can do with accounts like buildings and equipment and vehicles. They will depreciate over time because we will be using a portion of its useful life to do business. And that pizza oven is cooking my pizza, allowing me to sell my pizzas. So without my oven, I couldn't sell pizzas. And so it's directly related to me being able to be in business. And so I can depreciate it. So this is how depreciation works. There's no calculation here. They're simply going to give you what the depreciation is. So here, Sierra Corporation has equipment. They have office equipment. And they have calculated the depreciation at $480 for the year or $40 for the month. And since we are simply looking at October records, we're going to simply record the $40 depreciation expense for October. So at the end of October, we will debit depreciation expense for $40. The difference is we do not credit the equipment account. We credit something called the accumulated depreciation for equipment account. And this is important because we keep the equipment account sort of separate from how much of it we've used or expensed through depreciation. And so we've created a brand new account called accumulated depreciation for equipment that sort of piggybacks on the equipment account. You saw it on your balance sheets. You had equipment less accumulated depreciation on equipment. It's a separate account that shows us how much of it we have depreciated over time so far. So this is the entry for depreciation every single period: a debit to depreciation expense and a credit to accumulated depreciation. As you see, that also gets posted into their specific accounts. So the debit to depreciation expense would show up in the ledger on the debit side of the depreciation expense account. Accumulated depreciation for equipment is actually an asset account, but it's something called a contra asset account. A contra account is an account that has an opposite balance from its normal state. So a contra asset account is an asset account with a credit balance, which is different because all asset accounts have debit balances, right? So that's what the word contra basically means. And so, accumulated depreciation is going to show up here. That's important to know because, I think it's on the next slide, yes. Because this is how we know what the book value of a piece of equipment is. We take what we paid for the equipment, which in this case, Sierra Corporation paid $5,000 for the equipment. And we subtract out how much of that equipment we have depreciated. Now remember, it's called accumulated depreciation because we literally are going to be holding this equipment for many years. So this number is going to accumulate. It's going to grow slowly, slowly, slowly. Every time we have a depreciation expense, we will see the accumulated depreciation increase. And the difference here is called the book value. So what is the book value of the equipment? 4960 is the book value of the equipment. Why? Because we bought it brand new for 5,000 and we've already used up or expensed through depreciation $40 of it. And that's basically what that means. All right, so basically speaking, the adjusting entry is always the same, a debit to the expense account that's specific to what we're talking about, and credit the asset account that's specific. What happens if we don't adjust it? What if we just simply skip this step and put our income statement together? Well, first of all, one of the biggest problems is we'd be missing a whole bunch of expenses. And so all our expenses would be smaller than they really are, which would make our profit look bigger, right? And that would be misleading our owners to how profitable the company really is. It also means we have our assets are still looking quite large because we didn't reduce any of those asset accounts. It's almost like we have all those assets, but we really don't. So the problems in not adjusting would show up certainly on the income statement, which is very important, but also on the balance sheet. Okay. Unearned revenue is the only liability account that we worry about because this is a liability showing that we received cash from a customer and we owe the customer some work. But what happens after we do the work? It's no longer a liability. It's actually our revenue. We've actually earned it. Remember, revenue is earned. This is called unearned revenue because we haven't earned the revenue, unearned. We owe the work. Okay. Once we do the work, it's earned revenue, which is what revenue is. So unearned revenue is very common. It happens in lots of different industries. Some landlords, whether they have homes or whether they own malls or office buildings, will sometimes get clients that pay rent up front, sometimes for the whole period of time. Well, that's unearned rent revenue because they owe the customer, their client, the months or however many months rent they've paid up front. They can't actually say it's their revenue until that month begins and the client is still in the building, right? Airline tickets, you usually buy these ahead of time, right? If you're planning a trip, you're buying airline tickets now for, say, a summer vacation. Well, you're paying for those airline tickets now. Well, the airline owes you a trip. They can't say it's revenue yet. It's a liability. It's unearned revenue because they still owe you the trip. But once they actually give you the trip, then it's revenue. Then they've actually earned it. Magazine subscriptions are worked the same way. Any type of customer deposit up front, whether you put money down on a cruise or some type of vacation, or you bought tickets to a concert or sporting events, that is all unearned revenue. That's a liability because they owe you what you paid for. So the day of the game and the game is being played, they can say it's their revenue that day, but not beforehand. Before that's a liability. So that's important. That's important to know. So this needs to be looked at, right? This needs to be looked at because if we earned any of that, it doesn't need to be a liability anymore. It needs to be a revenue. So in other words, we need to sometimes decrease the liability account and increase our revenue account if we've earned it, if we've actually delivered. And so the proper adjustment here would be to debit the unearned revenue account and credit the revenue account because the revenue account is on the income statement. Unearned revenue is on the balance sheet. It's a liability account. Okay. So that's why this adjustment is important. So here's how it works. Remember, Sierra Corporation received a $1,200 cash advance from their client, Arnox, right? So, so that's what's sitting. This $1,200 is sitting in unearned revenue. At the end of the month, they evaluated the services, and the company actually earned $400 of that $1,200 for our docs by performing the guided services. So they have to do an adjusting entry. They have to take the money out of the liability account. So they debit the liability account. And they got to put that money into the service revenue account because they've earned it. So it belongs on the income statement. That's the adjusting entry. What you see is when it's posted, now the liability unearned service revenue is actually down to $800, not $1,200 anymore. And look, revenue was adjusted up. Again, service revenue, very first account on the income statement. That's got to be right. All those expenses as well, they have to be right. We have to do everything we can to make sure it's right. And that's the purpose of the adjusting entries. Okay. What if we didn't do that? What if we didn't do the adjusting entry? Well, a big problem is we would not be able to show that that revenue was earned. Remember, revenues are where the profits of the company are, right? Revenues minus expenses is net income. Net income, in essence, is leftover revenue, right? Revenue you didn't spend keeping the store open, right? That's your profit. So clearly, if your revenue is understated, your profit is going to be understated. And that's not going to make anybody happy if you're an owner. And then, of course, because you haven't adjusted that liability, it looks like you are in debt more than you are on your balance sheet. And that's not accurate either. So there's a problem for you not to make this adjustment. And so we come to the end of objective 2, which is all about those 4 deferrals. Remember, there's only 4 of them that you have to know. 3 of them are about assets that turn into expenses. We call those prepaid expenses. One of them we just reviewed, unearned revenue, which excuse me, starts as a liability, but ends as revenue when we earn it. So here are all different types of accounts from a company called Hammond, at the end of March. And 4 things they've noticed here. So 1, they've used up some of that insurance. Okay. 2, they only have $800 worth of supplies left. Okay. 3, some of that equipment depreciated. And 4, they actually earned $4,000 of that unearned revenue. So in other words, look how many accounts are off, right? Prepaid insurance is off, supplies is off, accumulated depreciation is off, and unearned service revenue is off. All of these accounts come from the ledger. The ledger is not correct. So we have to adjust for that. So let's do the prepare the adjusting entries. First one is insurance. They'd actually just give you what it means. So for the month of March, you would debit insurance expense, credit prepaid insurance for March 31st. So you should have a date here. Okay. Again, notice insurance expense, prepaid insurance, these accounts are always the same when we do adjusting entries. They always pair up. Supplies on hand. Well, look, if you started with $2,800 of supplies and you only have $800 left of that, you used the difference. You used $200 of supplies, so you expense that. Supplies expense of $2,000 debit, credit supplies of $2,000, and we're good. Now everything is correct. We have equipment depreciating at $200 a month, so let's just write that off. Depreciation expense, debit $200. Accumulated depreciation for the equipment, that should be with an equipment here, for $200 on the credit side. Right. And the last thing is we earned $4,000 of the $9,200 in unearned service revenue. So we have to lower that. Again, unearned service revenue has a credit balance. We lower it on the debit side. So the debit to unearned service revenue will lower that balance. Where does that money belong now? Well, we've earned it. So it belongs on the income statement under service revenue. Okay. So I'm going to take a quick break and ask if there's any questions here. Lots of questions. Good, good. Well, let's continue on. We got 3 more to do in learning objective 3, and then you'll be well adjusted after all these adjusted entries, for sure. Okay, so let's continue. Learning objective 3 continues those adjusting entries, but now we are going to be focusing on accounts that we would consider to be accruals. And accruals basically are, we want to make sure the revenue is recorded, even though we haven't received any money for it yet. And we have to make sure the expense is recorded, even though we haven't paid yet. So if it happened in that period of time, the revenue and expenses need to show it in that period of time. We have to follow the revenue and expense recognition principles. So accrued revenue, basically, again, you have performed the work, but you have not received the cash yet or haven't recorded it in your books yet. Well, you have to record it, okay? And so basically speaking, oftentimes we will perform a service and may not write it down right away. Certainly if we performed a service in June, it has to be recorded in June, even though we didn't remember it until July. Okay. So this is about really matching the correct period of time. And so basically we need to create a receivable in order to record the revenue. So accrued revenue is actually quite simple because we're going to debit accounts receivable and we're going to credit revenue. Okay, it's very simple to do an accrued revenue. So this is how it works. Sierra Corporation performed guided services for $200 that were not billed on October the 31st. So that revenue was performed, those services were performed in October. The revenue has to be recorded for October. Then you, of course, you have to bill the client to collect that. So this simply is corrected with an adjusting entry by debiting the accounts receivable for $200 and crediting revenue for $200 in the month it was actually earned. Again, these were earned in October. We have to record them in October in this case. So that's the journal entry. And then, of course, we would adjust those balances when we posted them to their ledger accounts. Accounts receivable would be adjusted by $200 on the debit side. Revenue would be adjusted by another $200 on the credit side. Look how much revenue has grown, right, through the adjusting entries here. What happens if we didn't do the adjusting entry? 2 things would happen. Probably the most important thing, as I mentioned, is the revenues would not be accounted for. And if you don't have your revenue showing, you're missing profit. You're not just missing revenue, you're missing profit. So it's super important to make sure all your revenue is recorded. And then, of course, your assets would look a little bit smaller because you wouldn't show any receivables, and which in fact you would need to. So not doing this accrued revenue entry would screw up revenue and an asset account. There are 2 accrued expenses that the book covers with you. An accrued expense is an expense that happened in that particular period, but you haven't paid it yet. Okay. And so it's very important that you record the expense, but then you have to set up, basically, since you haven't paid it yet, you have to set up a payable. You have to set up a payable for that. So there are many instances of expenses that might happen that you haven't paid yet. Interest on loans, which we're going to talk about, taxes, utilities, and salaries, which we're going to talk about. So this book focuses on the fact that we will have 2 specific accrued expenses to worry about: interest and salaries. And let's take a look at each one. Okay. So when we fix an accrued expense by the end of the month, we have to debit the expense account, remember, All of this is happening because we have to make sure all of our revenue and all the expenses are accounted for. So this debit to the expense account puts that in the expense. And then, of course, we would need to credit some type of payable account to show we're going to pay it in the future. Again, recording the expense even though it hasn't been paid yet. So we debit the expense, credit a payable account of one type or another, as you'll see. So accrued interest is a very interesting concept, because when a company takes out a loan, in this case, remember, Sierra Corporation signed a 3-month note payable. You don't pay the interest until it's due. So even though they took this loan out on October the 1st, they don't have to pay back the loan or the interest until January the 1st, which is 3 months later. Okay. Well, what happens is interest is accruing every day on this loan. And so you will have interest on this loan for October and for November and for December, even though you're not paying it until January 1st. So this means that literally anytime a company has a loan, the interest on the loan can be expensed. Okay. So the interest on the loan, any loan for that matter, can be expensed. It's considered a cost of doing business. All right. The principal isn't expense, just the interest on the loan. All right. And so what happens is we have a note payable, a 3-month note, and we've just completed our first month, October. So this note, which is a $5,000 note at a 12% annual interest, this is an annual rate, all 12 months. That's why we have to multiply it by 1/12, because we're only interested in 1 month's interest of the 12 months. So the time here really talks about how much, this is an annual, this is all 12 months. The time tells us we're only interested in 1 month of those. So this loan actually costs $50 for the month of October. All right. We're not going to pay it until January the 1st, because a note payable, you pay everything when it's due. But because this cost us $50 in October, we can expense $50 in October for that interest. And so we do. We debit the interest expense for $50. But since we're not paying this interest until later, we credit accounts payable. There's the liability account showing that we need to pay this interest. We've already expensed it, but we still need to pay it. And that's a very important accrued expense to do, because most businesses have some type of loans. And so every month, clearly, interest is accruing on these loans. So they have to expense the interest in the month that it happened, even if they're not paying it until later. And this is basically how they do it. Okay. So the journal entry is here. And as you see, when it gets posted into the ledger, it adjusts the balance for interest and expense and interest payable. One last one, accrued salaries. Now, you've probably been working at one job or another in your lifetime, and you know that you have to work before you get paid, right? So you're working, and then you put your time card in, and then usually you have to wait a week or two to get paid for that time. So in essence, your employer owes you the money. So it's very interesting how employers see it. Look at Sierra Corporation as an example. They pay every 2 weeks. The last pay period in October, as you see from this, was Friday the 26th. Now they're only open Monday to Friday. So as you see, Monday, Tuesday, and Wednesday of the following week happened in October, but the next payday isn't until November. Well, if this work happened in October, it needs to be expensed in October, even though we're not going to pay it until November, the very next pay period. So this is how it works. If they have a $2,000 payroll for every week, for every 5-day work week. 3 of these days happened in October. Okay. So $400 per day, that's 2,000 divided by 5, $400 per day times 3 days in October means that $1,200 worth of salaries should be expensed in October, even though they're not going to be paid until November. So that requires an adjusting entry as of October 31st. And so on October 31st, we are going to do a journal entry showing a salaries and wages expense of $1,200 for October and salaries and wages payable, right? Because we owe that. So we're going to set up a liability of $1,200. Okay, that will be paid on the next payday. But that's an adjusting entry that wasn't there before. And so once that gets posted into their ledger accounts, you'll see the salaries and wages expense increased for the month of October. And of course, now we have another liability in the month of October that was recorded that will show up. Okay. So what happens if we didn't do these, right? The most important thing, as you know, is those expenses would not be there on the income statement, which would make our profit look bigger than it is. And, owners do not like to be lied to. They don't want to feel, you shouldn't tell them they're richer than they are, right? And not only that, you wouldn't be showing those liabilities that you owe anything. And so it looks like your company has less debt than it has. And so that's not true either. So again, the importance of the adjusting entry is to make sure, in this case, the expense is recorded properly and that we set up those liabilities to show we're going to pay them later. Okay, so this is basically the summary of all of that. Learning objective 2 were your deferrals. Learning objective 3 was your accruals, but they basically are all about adjusting accounts to make sure. Notice that expenses or revenues are affected in every single adjusting entry. That is on purpose because the very first statement we do is the income statement. So we better make sure all the revenue is there and all the expenses are there. That very first financial statement matters greatly, and it has to be done right. Okay. And so again, the purpose of all these adjusting entries is to make sure we are as accurate as possible. Okay, so do it exercise number 3 basically focuses on these 3, and there's only 3 accruals that you learned. 1 accrued revenue and 2 accrued expenses, and that's all you're going to be tested on and so forth. So here we are at the end of the end of August for Microcomputer Services Incorporated, and they have a few things going on. They owe employees $800 in salaries. It's not going to be paid until September. The company borrowed money from a bank. We know it's a long-term liability. We don't care about it because all we really care is what's the interest for August, right? What's the interest for August? And the last thing here is it looks like they performed services, but they never recorded it. So that's got to be recorded. So prepare the entries. So first things first, they owe the employees $800. Again, on August 31st, we have to make an adjusting entry showing that $800 was part of an expense for August. So we debit salaries and wages expense, $800, and set up the salaries and wages payable for $800, showing we'll pay them in September. Happens to be the very next day, but we don't care. In accounting, it just has to be accurate. This is usually the trickiest one, the whole interest thing. We don't care how long the mortgage is for. We don't care how long the loan is for. All we care about is if we're only doing the books for August, what is the interest expense for that month? So to calculate it, we take the $30,000 which is the original loan, multiply it by the interest rate. This interest rate is for all 12 months. So we have to multiply that by 1/12. That's the interest. And when you do that, you get $250. And so for the end of August, you would have a debit to interest expense for $250, a credit to interest payable for $250. And that's the adjusting entry for that. But that's going to be your toughest one. A lot of people in past classes, this is where they kind of skip a little bit. The third one should be the easiest one because they simply forgot to record their revenue. They earned $1,100 in August. They never wrote it down, so they have to set up a receivable. Basically, they got to bill the client for $1,100 and put that money in their revenue because it has to show up on the income statement. And we just did all the adjustments that you need to know. Any questions?